Hey everybody, welcome to the Curzio Research YouTube channel. I'm Daniel Creech, research analyst here at Curzio Research. Thanks for tuning in. Today we're going to talk about one of the great financial debates. When it comes to your mortgage, should you just set it and forget it like your favorite infomercial, pay the same mortgage rate every month for say 30 years, or should you try to pay it off faster than on schedule and save on total interest principal paid? I'm going to go over the pros and cons of that, give you my opinion, a few exceptions, because there are exceptions, of course. Let's get right into it. Now, switching over here, this is just a bank rate calculator here, and then a lot of this pre-fills, and I want to set the environment and the context here, because I understand I'm painting with a broad brush. I know there's a lot of details depending on states, property taxes, insurance, all that kind of stuff. So I'm not saying these are precise figures. I'm trying to give you an example and a macro example because I want to give you a couple perspectives to think about when you're making a decision as important as this, a financial decision that goes over many years and compounds into a lot of money and wealth. So as you can see from this example, this is starting out with a $425,000 home price. That seems high or low to many of you. And you can see here the St. Louis Fed, the good old St. Louis Fed here, Federal Reserve of St. Louis. They show a median home price, give or take, of $403,600 in March of 2025. Again, we're just using these as examples. So $425,000 home amount. This has a $85,000 down payment, your typical 20%. Again, I know there's a lot of adjustments that can be made. First-time home buyers in Florida can put 3 to 3.5% down, but then again, you have your insurance and costs like that. So moving on here in broad terms, you have a loan amount of 30 years, 7% interest rate. This is a North Florida zip code, 32034 there. And this gives you your $26.08 a month. Now, these are around interest rates, give or take today. We can change this here to say 3.5 and just hit update. And you'll notice that we go from the $2,600 to $1,873 per month. And again, you can fluctuate with these, but the ultimate concept and what I want to get you to understand is where I want you to think about your financial empire, financial you and your family, and how do you rank who gets paid first and foremost. And I want to get into that in a little bit more detail. What I mean here is that if you go on this schedule here, and we just use this 3.5 interest rate, and what I did was I just copy and pasted an Excel example. So if you look here, on the left side, you have a 3.5% mortgage, and on the right side, you have a 7%. And we're using the same example I just showed, the $425,000 home value, the down payment of 20%, $85,000. At a 3.5 interest rate, your monthly payment is the $1,873. Looking out 12 months, that's $22,476. Over the course of 30 years, that's $674,280 roughly, or as you can see at the very bottom, that's 158% over the home price of $425,000. Whoa, that gets your attention. More on that in a moment. On the right side, you have the same home price, $425,000, down payment of 20%, which is $85,000. Monthly payment, because of the much higher interest rate, is about 39% higher at $2,608 per month. Times 12 months, that's $31,296 a year. And then a total over the 30-year life of the mortgage, you're paying $938,880 roughly, or 221% over the home price value of $425,000. Let me concede right now, because I know many of you out there are just saying, listen, I need to hear no more. You tell me that over 30 years, I'm going to spend over 150% or 220% more. And again, depending on the amount put down and the interest rate, these could vary drastically. Why in the flying Florida would you ever think of paying these types of over and above the home prices over that long period of time? Many of you just stop the conversation right here and say, listen, I don't like the ideas. That just looks so one-sided. Look at the excess price amount being paid. Not for me. I'm paying off this as quick as possible. I understand that knee-jerk reaction, but that's not the entire story. That's not the entire piece of the puzzle. And what I want to get you and what I think is valuable here to think about is you don't want to just look at the price paid, but you also want to look at the value and the purchasing price of the money being paid. And said a different way, you have to talk about inflation. And I understand that inflation is kind of a crazy word right now because it's politically charged, I understand. But if you Google or just do any research, your Chat GDPs, your Groks, your Geminis, any AI bot, these are some screenshots, and this is from Grok. But if you just look at what has the inflation rate done, or said a different way, what's the value or change in the value of your US dollar or purchasing power over the last 30 years? So for this example, we're using this prior 30-year mortgage. And if you look here, I'm going to try to be, ballpark figure-ish, but I don't think it's really that long or huge stretch to think that inflation has eroded or eaten about 50% of your purchasing power. And again, there's different things here, and it gives examples on, hey, if it costs $1, it costs $1.50 or more. Even if it costs $1.40, you're still talking massive inflation over a period of time. And again, you can look at different sources and such. So that's, everybody understands, inflation is tough and it hurts everybody's in their pocketbook, because as we've seen over the last couple of years, inflation is the rate of price increases. And when it's 8-9% year over year, it's crazy. Our Federal Reserve only wants prices to rise. Remember, they only want prices to rise on average 2% every single year. Now, I understand that in simple looking at price, you're paying a lot more in those dollars. But now, hopefully this inflation piece helps you understand that the purchasing price of the dollars today do not buy you near what they did back then. And this kind of helps us transition into how you rank your finances. And I'm not here to preach to you, but I just want to give you an example on how I view my finances. So for Daniel Creech, the list of most important on finances is tithing. I want to tithe. Then I want to pay Daniel Creech. That's number 2. And then everything else is creditors, banksters, mortgage, whatever. And I say that as a compliment to my banksters friends. My opinion, or at least what I want you to think about, is in your financial ranking, you should either be number 1 or number 2, and quit putting other people or third parties, banks, et cetera, ahead of you. In my opinion, I want you to kind of think about that in big terms. So getting back to this inflation rate, and if inflation is really taking the purchasing power away, then what I want you to think about is you want to control the dollars today in the most beneficial way to you and your family. Maybe that's paying off a mortgage debt, but maybe it's not. So the other question is, when you figure out this decision you want to make, is what else would you do with the money? Because there's different statistics, and again, it can vary down around the interest rates and down payments. But essentially, over 30 years, if you make one extra payment a year, you could cut, say, 5-ish, I'm rounding, 5.5 years off your mortgage. So you could save 5 years of principal and then some interest payments. That could be 6 figures, if not more. When you're making this decision, I want you to take into consideration the total price paid. We looked at that. You're paying 100 to 200% more over time. I want you to look at the purchasing power and inflation rate, and then I want you to look at the rate of return, or at least think about how you can put your money to work outside of that. And here, and again, you can do some research, and I encourage you to go use your Google machines or your AIs, whatever your favorite sources are, and look at the returns in the markets, because we're just using a simple some S&P 500 data. And again, we're using this 30-year scenario here. So going back to 1995 and then 30 years, we're looking at market returns. Now, I understand that the past 30-year performance is not dictate and is not guaranteed to be mimicked or mirrored in the next 30 years. Again, I'm not telling you to not pay off your mortgage and to invest in stocks. I'm simply showing you a perspective on how to get that money to work for you in the big picture. Now, I want you to remember this exorbitant amount of money, or over the purchasing price that we're paying in my examples, of 150% or 220%. Because this is going back to 1995 and saying, hey, if you invested $100 in the S&P 500, that would have grown over the next 30 years to almost $2,000. And if you look at this rate of return, assuming you reinvested all dividends from 1995 to 2025, that equates to about 10.5% rounding up per year, or you can see the 1895. Now, that's a little bit misleading, as all numbers can be, because this is assuming that you have that money in a pile of money and you're just putting in a lump sum. Most of us, including me, are not Scrooge McDucks. We don't have piles of money. If you have a mortgage rate, it's because you're either using the other people's money. You don't have just a lump sum to put down and buy the house or to invest. You're doing this over time. You're getting paid on a monthly basis. You have monthly income. And the difference between what your expenses are and your income, your living expenses, and then you're trying to save every month. So most of us are in this dollar cost averaging or multi-stay or savings over time concept. And so what I like about this is this says, hey, if you didn't have a lump sum, if your dollar costing average that same amount, your growth, while it's not the same, because remember up here you're up 1,800% or 1,800% and $1,900, excuse me. So that drops down to $1,500, okay? But my point here is that these returns are still incredible. No, they're not. You're not getting, 2.5 or 2x your money, but you're still getting 400 or 500. Even if you're conservative, you're getting, over 10x your return. And so when you think about in terms of, and I get the knee-jerk reaction of this example here, when you're paying 158% more or 220% more, but again, and again, I'll show you this percentage calculator. $100 into just $1,100 is 1,000% return. So $1,100. So I'm being conservative, even from the dollar cost averaging and $1,500. It shows you it turns out to be. I know these numbers can be difficult to follow. I'm not trying to confuse you. I'm simply saying, if you had paid your mortgage on a regular basis, just every month, set it and forget it like your favorite infomercial, and you took any excess money and you invested it over that 30-year period, you would have made a lot more return, even in excess of what the higher rate or total amount you would have paid on your home price with the mortgage rate. Now, here at Curzio Research, we're huge fans of capitalism and stocks, obviously. We think everybody ought to have exposure to the market in general because capitalism is one of the greatest, if not the greatest, wealth creation we've ever seen in economic history. But my point here is not to tell you to not pay off your mortgage as fast as possible and invest in stocks. It's to open up the idea to get your money to work for you. Even if you put that excess savings in a rainy day fund and you get X amount of months of living expenses that you feel comfortable, and then you want to invest or you want to start a small business or you want to just save some more money under your mattress. If you want to put some in a compounding interest-bearing account, now the interest rates aren't zero, you could get some return on your money. The point here is I want you to understand the optionality, and you have a lot of money flowing through your hands, and I want you to think about how you distribute it and to who, in what order, because that could benefit you. Now, another thing to think about is the opportunity and the deal that you have with a mortgage. Now, generally speaking, I understand there's exceptions. 2008 financial crisis, home prices plunged. But over time, the odds of an asset like a home appreciating or going up, going higher in value over time are in your favor. And that's because of the greater monetary system we're in, which is an inflationary system, which is the money is not backed by anything other than the military. That is an inflationary system, meaning the purchasing power of the dollar is all but guaranteed to go down over time. You can't control that. That's in more detail in another podcast. But the point is, back to the deal that you have and the options that you have, think deal or no deal. You have the opportunity to buy an asset that, in theory, and the odds are will appreciate over time. You can also use the asset, literally, stay dry, cool, warm, raise a family, make memories that you can't put a price on. You can use it. And you have the opportunity to pay off that asset with dollars that are all but guaranteed to be less valuable in the future. It almost seems ridiculous to have that deal, but that's the world we live in. When you see deals that you really think are too good to be true, you ought to investigate them. Or if there's deals where you probably wouldn't want to loan if the tables were reversed, you ought to investigate them. Not that they're bad or stay away, but investigate them because if they're great opportunities, you want to take advantage of those. I know a lot of people with mortgage rates under 3.5%, some even under 3%. Why you would think about paying off that loan first before yourself, I don't understand. I'll give you my exception here in a moment. One last thing to think about in terms of when you're paying off the mortgage faster, what you're essentially doing is you're waiting to save I give you a lot of credit because you are deferring gratitude, you are paying off a debt, and you are putting off your own pleasure until you get the money. So in this scenario, again, this is the 3.5% interest rate. If you're paying this rate off faster, well, let's change the rate actually back to 7 to make it a bigger example. So this 2608, if you're paying the bank off as fast as you can, essentially what you're doing, you're waiting out until a point in the future to where you can start saving this $2,608 every month. That will start going straight to your bottom line. The point is, though, and remember, no matter what, when you start saving that 2608, it's not going to buy you the same amount of goods as it does today. And so that's what I want you to think about. Yes, you're going to pay more in price total paid, but the value of that and what you can do with that money, whether you invest it in a business, save your money, look to invest it in stocks, real estate, you have optionality. Just understand the optionality you have and rank yourself near the top of your financial rankings or financial system. Now, the other thing is, I don't want to act like, hey, put it in the market and it goes up nonchalant for 30 years because you have 2000, 2008, you have market setbacks. So I'm not trying to paint just, set it and forget it type deal. But I want you to understand the concept and the power that you have to put that money to work for you. So in general, Daniel Creech, Crystal Ball says, whatever your interest rate is, and go through the details of more detailed of your deal. But think about putting yourself first. Think about weigh out the options on what you're going to pay over the price paid and then the value of that. And then what I also want you to think about is how the financial money is emotional and it will affect everything else. Just accept that, understand it, deal with it. You're smart enough and you can handle it. The one exception, all right, the one exception I have here, because none of us use money 100% efficiently. If it just absolutely drives you crazy to be in debt, or if it bugs you, if it feels like it's just in your gut and you can't concentrate and it's going to spill over and it's going to cause stress or cause physical harm or physical health problems, by all means, pay off the loan. I have family members, I have good friends that just absolutely shouldn't have hate in your heart, but they just hate the idea of owing money or any in debt. And it doesn't matter if you show them on paper and say, hey, this isn't scary, it's using leverage in a proper way, here's how you can increase your standard of living. I understand money is emotional, and if it's just it itches you or eats you at night and you can't sleep because you just don't like this overhanging, by all means, pay it off. Get, with you or your significant other, make a plan, stick to the plan, just go ahead and do that. That is my one exception if it just bugs you to death. If not, focus and at least think about the perspectives on putting you first, how to use your money most efficiently, and don't think of just price paid, but think of purchasing power and the money behind that. Hopefully you enjoyed this. Like me, love me, don't ignore me. Daniel at CurzioResearch.com. That's Daniel at CurzioResearch.com. Be sure to check us out at Curzio Research, Wall Street Unplugged, and Wall Street Unplugged Premium. Until next time, cheers.